Imagine this. You purchase an insurance policy, pay the full year premiums, and walk away, trusting you have done everything right and you're covered. Then one day, your insurance company collapses or is declared insolvent before your claim is settled. So here's the question. What happens to your payout? Do you lose everything? Or is there a safety net? Let's find out. Hello, and welcome to Insurance World TV, where we break down complex insurance topics into simple, practical knowledge. Today, we're talking about something incredibly important, especially in light of recent happenings, where 3 insurance companies were placed under statutory management by the industry regulator, the Insurance Regulatory Authority. Following these actions by IRA, policyholders were thrown into confusion and panic, with many of them asking, "What happens to my claim? Do I lose my money? Is there any protection for me?" Well, there is a safety net, and it's called the Policyholders Compensation Fund, PCF. In this video, we demystify this safety net to understand what it is, when was it established, how it is funded, and most importantly, how it works. Question 1. What is Policyholders Compensation Fund? Policyholders Compensation Fund, abbreviated as PCF, is a fund within Kenya's insurance sector, established in 2004 to protect policyholders and claimants by providing partial compensation to individuals affected when their insurance companies are not able to pay claims because of having been placed under statutory management or had their licenses canceled. It is a safety net established by the government, designed to protect insurance policyholders when an insurance company fails. PCF ensures that policyholders and claimants are not left empty-handed. When an insurance company is placed under statutory management, it means that the company is in serious financial trouble and is not able to meet its financial obligations. At this point, the company's normal management is removed and replaced by an appointed statutory manager who takes control of operations. The goal is to stabilize the company, assess its financial health, and determine whether it can recover. During this period, the normal business of the company, such as issuance of new policies or settling of claims, is halted. This is necessary to enable the new manager carry out a detailed review of assets, liabilities, and outstanding claims. However, it is important to understand that this is a legal and administrative process, and as such, it can take a considerable amount of time. In some cases, statutory management has taken several years, sometimes up to 10 years, before the full financial position of the company is established and meaningful progress is made in addressing its obligations. This is because the process involves detailed audits, verification of claims, reconciliation of assets and liabilities, and compliance with legal procedures. As a result, policyholders may experience significant delays before claims are fully processed or settled. As this process is going on, what happens to the clients or the business owner who is waiting for a claim to be settled so they can restock and keep their business running? Can they realistically afford to wait that long? And ultimately, is it fair to expect them to bear the burden of such delays, especially when they had taken insurance in good faith? This is where the Policyholders Compensation Fund comes in. It serves as a financial safety net, stepping in to settle claims when an insurer is unable to meet its obligations, particularly during liquidation. Because the winding up process can be lengthy and uncertain, the PCF ensures that policyholders are not left completely exposed. By providing partial compensation, it helps cushion financial loss and preserves confidence in the insurance sector. Governance and management. The Policyholders Compensation Fund is governed by a board of trustees, which is responsible for overseeing its operations, ensuring accountability, and making strategic decisions on how the fund is utilized. This governance structure is critical in maintaining transparency, discipline, and public confidence in how policyholder funds are managed. In practice, the PCF plays a very active and hands-on role when insurers face financial distress. One of its key functions is managing distressed insurers, where it may be appointed as a statutory manager or work closely with appointed managers to stabilize operations, assess liabilities, and protect the interests of policyholders during uncertain periods. In cases where recovery is not possible, the PCF also supports liquidation processes. This involves working alongside liquidators to ensure that claims are properly documented, verified, and settled in an orderly manner. The fund may also help coordinate the distribution of available assets and ensure that policyholders are treated fairly throughout the process. Most importantly, the PCF's central responsibility is safeguarding policyholder interests. This means ensuring that claimants are not ignored or unfairly disadvantaged when insurers fail. It acts as a protective bridge between the collapse of an insurer and the financial recovery of affected customers. Through this governance and operational role, the PCF helps maintain stability, trust, and integrity within the insurance sector, especially during times of crisis. Question 2. What is the role of Policyholder Compensation Fund? As we have understood before, when an insurance company collapses, most policyholders fear the worst, losing their money, their claims, and their financial security. But this is exactly where the Policyholders Compensation Fund, or PCF, comes in. Established under Section 179 of the Insurance Act, the PCF is a government-backed safety mechanism that protects policyholders when insurers become insolvent. It works alongside the insurance regulatory authority to maintain stability and trust in the insurance sector. So, what exactly does the PCF do? First, its primary role is compensation. When an insurer is unable to pay claims due to statutory management or liquidation, the PCF steps in to compensate affected policyholders and claimants. This ensures that people are not left completely stranded. Second, it provides financial relief during disruption. Insurance is built on trust. If companies collapse and no one steps in, confidence in the entire system would collapse. The PCF acts as a buffer, ensuring that even in failure, there is some level of financial protection. Third, the PCF helps manage and facilitate the resolution process. It may work with statutory managers or liquidators to assess claims, verify policyholder entitlements, and ensure orderly payouts. Fourth, it promotes market confidence and stability. By guaranteeing limited compensation, The PCF reassures the public that the insurance industry is not a gamble, but a regulated system with safeguards. Question 3. How does Policyholder Compensation Fund work? The Policyholders Compensation Fund operates as a step-in safety mechanism when an insurance company can no longer meet its obligations. Let's break it down step by step. Step 1. The trigger. The process begins when the insurance regulatory authority places an insurance company under statutory management due to financial distress or inability to meet its obligations. At this stage, the insurer is no longer in a position to reliably pay claims, and control of the company is taken over by a statutory manager appointed by the regulator. From here, 3 possible outcomes may follow. The company may recover and resume normal operations, be taken over or merged with another insurer, or ultimately be liquidated if its financial position cannot be restored. For policyholders, this period introduces significant uncertainty. While existing policies may continue temporarily, claims processing may be delayed or subjected to strict oversight, and the overall reliability of the insurer becomes a concern. Step 2. The intervention. Once an insurer is placed under statutory management, the Policyholders Compensation Fund, PCF, steps in to safeguard policyholder interests. Depending on the situation, the PCF may be appointed as the statutory manager, or it may work alongside the appointed statutory manager or liquidator. In either case, its role is to ensure that policyholders are protected and that claims are handled in an orderly and structured manner, even as the insurer undergoes financial distress or resolution. Step 3. Claim submission. Once the intervention framework is in place, policyholders are formally notified and guided on the next steps through official communication channels. This may include public notices, press releases, or direct instructions from the statutory manager, liquidator, or the Policyholders Compensation Fund. Affected policyholders are then required to submit their claims within the stipulated timelines, following the procedures provided. This involves completing the relevant claim forms and attaching all necessary supporting documentation, such as the insurance policy document, proof of premium payment, receipts, and evidence of loss. For example, a police abstract in the case of motor accidents, medical reports for health claims, or repair estimates. Providing complete and accurate documentation is critical, as it enables efficient processing and reduces delays. At this stage, clarity, compliance with instructions, and timely submission play a key role in ensuring that claims are successfully considered for compensation. Step 4. Verification and assessment. Once claims are received, the Policyholders Compensation Fund begins a thorough verification and assessment process. This involves confirming that the policy was valid and active at the time of loss, carefully reviewing the details of the claim, and evaluating all supporting documentation provided. During this stage, the PCF determines the extent of liability and the amount payable, in line with the terms of the policy and the applicable compensation limits. This process is critical in ensuring accuracy, transparency, and fairness. Ultimately, it ensures that only genuine and valid claims are approved for compensation, safeguarding the integrity of the fund while protecting rightful claimants. Step 5. Compensation payment. Once the assessment process is complete, the Policyholders Compensation Fund proceeds to make compensation payments directly to successful claimants. These payments are based on the verified claim amount, subject to the applicable compensation limits. Traditionally, the maximum compensation payable was 250,000 Kenyan shillings per claim. However, this limit has since been revised to 500,000 Kenyan shillings following court decisions, providing greater relief to affected policyholders. It is important to note, however, that the PCF is designed as a partial protection mechanism. If the value of your loss exceeds the compensation cap, you may not recover the full amount, and the balance remains unrecoverable unless additional recoveries are made from the insurer's remaining assets. Question 4. How is PCF funded? One of the most important aspects of the Policyholders Compensation Fund is how it is funded, because this is what determines its ability to actually protect policyholders when things go wrong. The PCF is financed through a 0.25% levy on all insurance premiums paid by policyholders in Kenya. In simple terms, every time you pay for an insurance policy, whether it's motor, medical, fire, or life, a very small portion of that premium is set aside and channeled into the fund. Now, this may seem insignificant at an individual level. For example, if you pay a premium of 10,000 Kenyan shillings, only 25 Kenyan shillings goes into the PCF. But when you look at it across the entire insurance market, with millions of policies being issued every year, this small contribution becomes a powerful collective pool of funds. This is what we call a risk-sharing mechanism at a national level. What this means is that all policyholders are, in essence, contributing to a shared safety net. You may never personally need to rely on the PCF, but your contribution helps protect someone else whose insurer fails. And if the unfortunate happens and your insurer collapses, the same system is there to support you. This model is very similar to the core principle of insurance itself, spreading risk across many people so that no single individual bears the full burden of loss. The difference here is that instead of covering risks like accidents or illness, the PCF covers the risk of insurer failure. Another important point to understand is that this funding structure makes the PCF sustainable and independent. It is not reliant on emergency government bailouts or ad hoc funding. Instead, it is continuously funded by the industry itself, ensuring that resources are available when needed. However, the size of the fund is directly influenced by the total volume of premiums collected in the market, the number of claims are rising from failed insurers, and the timing and scale of insurer collapses. This is why, in times where multiple insurers face financial distress, there can be pressure on the fund because more claims are being made against the same pool of resources. It also explains why there is a compensation limit in place. The cap, currently at 500,000 Kenyan shillings following court decisions, is designed to ensure that the fund can support as many policyholders as possible, rather than being exhausted by a few large claims. So, in summary, every policyholder contributes a small amount. These contributions are pooled into a national fund. The fund is used to compensate victims of insurer failure, and this creates a system of collective protection and shared responsibility. At its core, the PCF funding mechanism is a powerful reminder that the insurance industry doesn't just insure risks, it also insures itself. So, the next time you hear that an insurer has collapsed, don't panic. Ask yourself, how does the Policyholders Compensation Fund protect me? Because in Kenya's insurance system, you are not completely alone. We have come to the end of our video on Policyholders Compensation Fund. If you found this video helpful, please like, comment with your thoughts, subscribe to Insurance World TV, and share this video because someone out there needs this information today. And that brings us to the end of today's discussion. Thank you for watching and for staying informed. Until next time, this is Insurance World TV, where we don't just talk insurance, we make it make sense.